Let's talk bonds and lots of news and data to move investors. Jim Stening from FIIG Securities with me, as he is every week. Jim, the CPI number yesterday, it was kind of dissected, as you might well expect after the event. The bond market, how did they read it?
Well, it was pretty much as expected. I think some of the quarterly numbers were a little bit higher than the average economist forecast. So really there wasn't too much sort of reaction initially afterwards. I think, interestingly, what we've got at the moment is this massive divergence between the headline rate and the underlying rate. And so I suppose if you want to take a bullish view on inflation, you focus on the headline rate. But realistically, the Reserve Bank does focus on, in relation to monetary policy settings, the underlying rates.
And Bill Evans from Westpac saying that underlying rate's still pretty toppy, still outside the Reserve's preferred measure, so he wouldn't rule out 50 basis points on Melbourne Cup Day. Are you in one mind over that?
I agree with Bill. I think that you can't possibly rule that out. I mean, fundamentally, if the focus is on those underlying numbers, and obviously these numbers will move lower, the headline and the underlying rates will converge over time to trough next year. But at the end of the day, if you look at where the current underlying numbers are, and then you look at monetary policy settings, well, you've got a zero real cash rate. So, I mean, the thing is that what they're talking about, or the Reserve Bank in their communications with the market, have said that they're looking to remove emergency levels. Now, emergency levels were implemented through large reductions. I think there were 4 reductions, 3 of which were 1%, one was 0.75. So to say that we can't expect a 0.5% is fairly, it's not that ridiculous.
And yet, Jim, is it all rather academic at the end of the day? Because we saw the troubling aspect of utilities, which the Reserve Bank can't control. It can move the levers of interest rates all it likes. It could up them by 1% in November, and still electricity and water costs wouldn't respond.
Yeah, look, that's right. I mean, the Reserve Bank, nobody can control these variables within the CPI. I mean, if you look at the last tightening cycle, early calendar last year, it was energy prices that were running away.
And that's the thing, though. If the Reserve keeps saying we are mandated to guard against inflation, but its very mandate can't be necessarily realised by its own actions, what are we talking about?
Yeah, look, I mean, that's right. It's a fairly rigid thing, isn't it? I mean, obviously, in times of crisis, there needs to be some give. And I suppose the way they're approaching it is that they're removing the emergency stimulus first. So that's not to say that we won't have accommodative policy. But if they do need to return to neutral, then they need to start to look at how they get that. Because at the end of the day, if we're talking about 0.25 increments, to get to neutral policy, we won't be there till this time next year.
And what percentage point do you define neutral as?
Well, I think if you take, realistically, if you say the core underlying inflation rate will trough, or forecast looking forward, or even the middle of the band is around 2.5, then if you normal neutral monetary policy setting is around 3 to 3.5. So 5.5 to 6% is probably where neutral monetary policy is. I mean, if you look at the average 90-day bank bill rate in this country over the last 15 years, we're talking about 5.8, 5.75%. So
now you would say on the back of that, go for a fixed rate at the moment, counterintuitively. It
is, yeah. Look, I mean, I think one of the interesting things about when tightening cycles are initiated, and bearing in mind that rigid guideline that the Reserve Bank works within, quite often that's a very good time to lengthen duration. Now, that does sound crazy, but what tends to happen is that markets really build in the entire cycle, and so then, throughout the remainder of the cycle, long-term rates don't really move that much. So, we have seen a big move up in these rates, and we will continue to see that through the early parts of this cycle.
Can I just move away from that for a moment and get your response to a corporate bond transaction yesterday, which some in the local market have really been disappointed over? Coca-Cola Amatil launching yesterday a deal offshore, $400 million US 5-year bond, paying a yield of just on 3.25%. Why go offshore when they could have tapped the local market?
Well, that's just it. I mean, the local market, I suppose. I mean, a lot of these companies make decisions on their own idiosyncratic requirements. I mean, arguably it might have been cheaper to fund offshore, but I mean, you know, essentially, is there demand at the top end of town? I'm not certain at the moment.
And is it largely a dollar play as well? The higher we ride, the less justification there is for dipping a toe into this market, because you can still get those deals offshore and not lose out.
Yeah, well, I mean, I suppose it's a cost of funding decision, so that all comes into the mix.
All right, Jim. Well, that one is a developing one because we're trying to get traction locally on the bond market, but it's not going to happen in 5 minutes.
No.
All right. See you next week.
Thanks, Carl.
Appreciate it. Jim Stening from